Well, good morning, everyone. Good morning, everyone, and what a beautiful Connecticut morning it is. I want to welcome you all to the Chamber's annual Economic and Investment Outlook. My name is Bill Purcell. I'm your devoted Chamber President, and I'm going to serve as your host at this morning's very special event. Let me begin by taking you back in time to Friday, March 6th, 2020. While it may seem like ages ago, that was the date that we gathered together over breakfast at Bronson Country Club in Shelton for our 2020 Economic Forum. And my, how things have changed since then. But thankfully, one thing that hasn't changed is that our two distinguished speakers from last year's event have honored and graced us with their presence once again. Unless you've been living in a cave for the past 12 months, you most assuredly know the first of this morning's speakers, Commissioner David Lehman. In a front-page story in the December issue of the Harvard Business Journal, David was credited with being a central figure in helping Connecticut business to navigate through this combined public health and economic crisis. David will be followed by Mr. John Traynor, the consummate gentleman banker, trusted investment advisor, and gifted speaker whose insights and wisdom are sought out regularly by the national media and leading business associations across New England and beyond. Gentlemen, thank you so much for joining us to both reflect on the past year and to help us to gaze into the future. I'm pleased to say that we have a full house on this morning's call and that our audience represents a cross-section of the Valley's rich and diverse economy. Each of them in their own way, each of you in your own way, has demonstrated fortitude, resilience, and ingenuity throughout this crisis, while all the while protecting the health and safety of your employees. So we tip our hat to all of you. While all of you are special guests, I'd like to call particular attention to two new leaders and Connecticut residents that are on the call this morning. First is Paul Lemo. Paul is the newly appointed president of Sikorsky, a Lockheed Martin company, the region's largest employer by far. Paul has enjoyed a remarkable 30-year career as a leader in the defense industry and has recently taken the reins at Sikorsky from New Jersey. Paul, welcome to you. And Dr. Dwayne Smith is on the call, the newly appointed Chief Executive Officer at Housatonic Community College. Dr. Smith arrived from St. Louis back last summer. And gentlemen, we want to all extend a very warm Connecticut welcome to both of you. Finally, we are thrilled to have our two presenting sponsors back with us again, People's United Bank and the firm of CliftonLarsonAllen, or CLA. So to kick off the program, it's my pleasure to introduce Chamber member and friend John Zinno, the principal at CLA. John has over 30 years' experience providing accounting, auditing, and advisory services to a wide range of privately held businesses. He also works closely with the nonprofit sector. He's a graduate of Assumption College in my hometown of Worcester, Massachusetts. Thank you, John. He's involved in many professional and community organizations, including the Connecticut Association of Independent Schools, the Palace Theater, United Way, and Junior Achievement. So John, let me turn the floor, I should say the screen, over to you for some remarks and to introduce our first speaker, Mr. John Zinno. Thanks, John.
Thank you, Bill. Appreciate that kind and warm introduction. And good morning, everybody. And thanks for being part of this very important session this morning. Bill mentioned CLA, very exciting news for our firm of Bloom Shapiro that merged in as of 1/1 into CLA. And CLA is a large firm located across the country with over 7,400 employees and 120 offices. And the CLA way is to create opportunities for our clients, for our people, and our communities by taking a passion towards industry-driven results and getting to know our clients, our people, and obviously supporting our communities. And I'd like to thank Bill and his entire team. I mean, this was a monumental task to get this forum off the ground and the platform that it is, and for their continued support of the business community within the Valley. So thank you so much. So it's my honor to introduce David Lima this morning. And David, thanks again for being with us. David is the commissioner and the governor's senior economic advisor. David serves as the commissioner of the Connecticut Department of Economic and Community Development, known as DECD. That state agency that oversees a wide range of programs, including promoting business growth, brownfield redevelopment, the arts, historic preservation, and tourism. David also serves as the governor's economic advisor. He's hard at work creating innovative public and private partnerships between DECD and Advanced Connecticut, formerly known as CERC. This will provide a new economic development delivery model for our state. David's business development priorities include helping building our urban centers into engines of growth, furthering the state's innovation and entrepreneurial ecosystems, and strengthening the state's workforce pipelines. Prior to joining DECD, David worked in the financial advisory industry. Most recently, he was global head of real estate finance for the investment banking division of Goldman Sachs, where he worked for 15 years. And personally, David, I want to thank you for the approach and the pro-business attitude that you've brought to the state of Connecticut, and it's greatly appreciated by our firm and certainly by all of our clients. So with no further ado, I'd like to introduce David to the stage to start speaking.
Great. John, thank you very much. And Bill and the whole chamber, it's great to be here. And thanks to CLA and People's Bank for sponsoring this great event. I do vividly remember still 1 year ago at the country club, John and I speaking, and financial market turbulence, still a lot of uncertainty around the virus. And, never in a million years did I think that 12 months later, we still would be navigating this at that time. What I wanted to do, though, today is I do want to take you through a number of slides. I don't want to have dueling slides with John Traynor. I know that's a losing proposition for me, but I'm going to share a few slides and offer my perspective in terms of where the state is vis-a-vis COVID, how we're thinking about the economy going forward, talk a little bit about the legislative session and other initiatives that we're pursuing. All right. I'm assuming everyone can see this, and if not, you'll tell me otherwise, the speakers will. All right, so first, the economic reality of COVID-19, and just going left to right here, a lot of these are numbers you may have seen before, but I think it is important just to recap. So in Connecticut, we almost had 3,000 jobs lost, peak to trough there in April. And you had 1.2 million people over the crisis applying for unemployment. You've seen unemployment in the state skyrocket, and though it has stabilized, we still have approximately 1 in 10 people in the state of Connecticut is out of work or underemployed. And as you may have expected, in our cities in particular, that's where we've seen the hardest hit as it relates to many of those jobs in the service industries. Economic activity contracted meaningfully, year over year, and certainly the second quarter GDP was down 31% in the state of Connecticut, and we're still down to just about 4% versus where we were last year. I'm sure John Traynor will have some comments in terms of what the second half of this year brings. I will say I am, with what I expect as it relates to the virus, the significant federal stimulus, and what seems to be a lot of pent-up demand, I'm very optimistic personally, both nationally and locally, for the second half of this year. I referenced the struggle in our cities and urban areas. It's not just where you've had a lot of the workers that have been subject to these layoffs residing, but the whole ecosystem of our cities, the commuters, the ancillary businesses that service those commuters, from parking to delis to theaters, all of that has been hit really, really hard. And I think many of those still will take a long time to come back, given where consumer confidence is. But again, I think that the second half of this year, you will see a significant rebound, but some of those sectors are going to take some time. Hospitality and restaurant, retail hit the hardest. I'll take you through some numbers there. We have seen a rebound lately, and the good news there, the silver lining, if you will, is, Connecticut's relative performance has been quite strong, certainly relative to the region, and we've been in line with the country. And then federal stimulus, John, I'll leave John to talk most about this, but the stimulus has been unprecedented. And today the House, as many know, will vote likely on this $1.9 trillion package, in addition to the trillions of stimulus we've had to date. There has not been a crisis where you've seen, I think all in 20 or 25% of national GDP in the form of stimulus, like you've seen in the past year, right? If you compare this to what you saw coming out of the financial crisis, where I think it was less than $1 trillion, and certainly the Great Recession, the Depression, almost 100 years ago at this point in time. So there's a real experiment here, and we can talk about inflation and some of the impacts of that too. But I think it's a positive that there's a stimulus, but there's really no playbook given the magnitude of it. All right, so let's dig into jobs a little bit more. So Connecticut's the red line here, and this is non-farm employment in aggregate indexed at 100 of February of 2020 to the December numbers. So the purple line is the US, the red line is Connecticut. As you can see, Connecticut in the Northeast, given where we were as it relates to the virus, we suffered more in that April and May time period, but we've regained those jobs, and our recovery is in line with the country, where our labor force is down roughly 6% year over year. But you look at where the rest of the region is, including Rhode Island, and other states that look like us. We can debate who the right analog is, but Connecticut's relative outperformance has been meaningful here and notable. Again, everyone's down, and that's not where we want to be, but I think it is important to mention this, and we can talk about why this is the case. And I think there are some reasons for this, but again, in line with the country, better than the region in terms of jobs. When we dig into it a little bit more by sector, and these are two significant sectors for the state of Connecticut in terms of labor force, both of which are around over 10%, I should say, of our labor force. So again, on the left, accommodation and food services. This is an industry that has been crushed, right? We went from 100 index down to, if you look at the red line on the left, 45% for Connecticut. So we saw more than 1 out of 2 people in the industry lost their job in the heat of the crisis. But now Connecticut's accommodation and food services employment is still 80 and change % of what it was last February, or February a year ago, but it's actually better than the nation and much better than the region. So, and again, we can talk about some of the reasons for this, but I think this may seem counterintuitive to some folks, but we have recouped many of these jobs, but you still have 1 in 5 people in this industry that is out of work, and obviously that's not acceptable. On the manufacturing side, slightly different story here. You look at the decline. Again, we're red in all of these, and you can see the purple, less clear on the manufacturing, just given there's not as much differentiation, but the country looks very, very similar to Connecticut. But what you saw, and this is largely as a result, in my opinion, of Governor Lamont's decision not to shut down manufacturing, construction, and other essential industries, when many of our neighboring states like Massachusetts and New York and New Jersey did that. We didn't think that was the right thing to do. We took a more balanced approach, in our opinion. And you saw Connecticut and Rhode Island, who took a similar approach to us. They lost a lot less manufacturing jobs in the spring of 2020. And as a result, recouping those jobs, it did not take as long. So Connecticut and Rhode Island have outperformed the region. You've seen, a reversion to the mean, for lack of a better word, outside of New York. But I think keeping the economy open, there was a realization last year. It's a lot easier to say close something than it is to restart it. So we didn't want to take that risk, and we wanted to leave stuff open where we felt it was appropriate. And we just didn't think it was the government's role to decide who's an essential manufacturer versus a non-essential manufacturer. The reality is we realize how supply chains work, and we wanted to keep it simple. I wanted to talk a little bit about financial support, and the federal program is the 800-pound gorilla. It has been, it will be. I think that's appropriate for Connecticut taxpayers too, but the state has done some meaningful things, some with state dollars, some with federal dollars. The first thing we did in the crisis last year is we had a bridge loan program and also a HEDCO line of credit for minority and women-owned businesses. So just under $50 million was awarded to around 2,700 businesses. Some of those were no-interest short-term loans just to buy some time before PPP, and some of those were forgivable lines of credit. Towards the end of this past year, with our COVID relief dollars from the federal government, the state had $1.4 billion in aggregate. We took $96 million of those dollars, 85 of which went to small businesses in 2 programs. So 12,000 small businesses received those grants approximately. And then performing arts centers and museums received $11 million. And obviously those centers just have seen very, very little business, some of which have been closed for the past 12 months. On the federal side, and this $8.8 billion does not include the current tranche of PPP. But you saw close to $7 billion into Connecticut in the first rounds of PPP across 60,000 businesses, and $2.1 billion in the emergency loans, the EIDL loans, across 20,000 businesses. In addition to this, the numbers for the PPP tranche that's out there right now is $2 billion across another 20,000 businesses. And obviously some of those are second wave or second tranche PPP loans. But again, the magnitude of this the federal stimulus is unprecedented here. And I think we're going to see that in the economy very, very soon. What else has the state done? I talked about deeming industries essential. It was a balanced approach. Governor Lamont, he was a small business person. He understands the risk reward. It's not always, we were always public health led, as he said, through the crisis, but we're always weighing the cost versus the benefit, and we're trying to make a very balanced judgment. And that was true last March, and it's true today as we're thinking about reopening. On the reopening protocols front, same thing here. If you look at what happened in Massachusetts and Rhode Island, and I'm not trying to pick on them though, but in November and December, they were pausing a 2-week pause, shutting down certain businesses again. We felt it was very important to try to maintain consistent protocols. I know some people want less government restrictions on this, but we thought stability and certainty was worthwhile and appropriate, and we did that throughout the the winter second wave, if you will. The third point on the top right here, and I think there's a lot of misinformation on this, what we call regulatory relief. So the governor, under his executive powers, he's issued a lot of executive orders since last March. But what I think is lost is 2 out of 3 of those orders was to actually relax restrictions as opposed to put on new restrictions. So deferrals and more time to pay your taxes, to get certain licenses. The example here about allowing restaurants to sell alcohol with their food sales when they weren't able to be open, that type of flexibility we thought was important. And many of these executive orders, again, it's not to make things more restrictive. It's actually to make things easier for business and individuals. I talked on the restaurant reopening. I talked about the consistent protocols. Don't want to go into that anymore now. But the tourism campaign I will mention, and I think this is going to be really important this summer. So the state spent $1.5 million in promoting tourism last summer. The hit rate for our website and reservations, especially given other parts of the country had more COVID than Connecticut, that there was actually a pretty good run for the industry in July and August. Not nearly what we need. But the governor's budget this year actually has kept the tourism fund held harmless, and we're going to make sure that we advertise and market Connecticut appropriately, because I think you're going to see a lot of people looking to months ago. People, the desire to be in cities in more dense areas. And I think long-term cities are still crucial. But I think what we've seen is Zoom works, Air Meets works, this type of framework where maybe not 5 days a week, but a couple days a week for industries that can work remotely, that's a win for the employer and a win for the employee. And we think Connecticut and what Connecticut's natural merits and strengths, we will be a winner in that. And I think you're seeing that in the housing market. On the state budget side, I'm happy to take any questions and go into more detail here, but I think what folks need to know are really 2 things. One, the governor's been very vocal on no broad tax increases. And we're really trying to compare ourselves here in many ways to what you're seeing in places like New York and New Jersey, where, they are going to raise taxes most likely. And Governor Lamont feels stability and certainty is really important. And we know that the state has not, if we're objective about it, provided that in the past. And that's not a Democrat thing. It's not a Republican thing. We know that the state needs to maintain tax certainty, and the governor's very focused on doing that, especially in the context of an economic crunch here. The second point is rainy day fund. We still have over $3 billion rainy day fund. It's 15% of the budget. We are potentially going to be using some of that in the governor's budget projection over the next 2 years, but we're in a rainy day and we think that's appropriate. And candidly, there's been a lot of upside in tax receipts, and that continues. Some of that has been related to the stock market, which is highly volatile, but tax and revenue growth continues to exceed to the upside too, and we hope to continue to see that happen. Housing market, I mentioned this, and happy to take any questions on this point, but we spent a lot of time looking at data on migration. And the Postal Service has both permanent and temporary changes of address. As we look at on a net basis into Connecticut, last year you had over 16,000 households change their address to Connecticut. And the four biggest states where folks were coming from were New York, unsurprisingly, but also New Jersey, Massachusetts, and California. And you also saw in that, and this is a net number, so we saw this is the move-ins versus the move-outs. A lot less people moved out last year. So listen, one year doesn't make a trend. We realize it was COVID, but if you look at inventory in the housing market, what you're seeing in especially in the starter home part of the market, it feels like you're going to see this is going to be a little bit longer than a one-year trend. Is it a longer-term trend? Again, too early to say. But the last time Connecticut saw this type of in-migration was over 10 years ago. So yet another reason we want to make sure we're projecting the fiscal stability, the tax certainty, and really leaning into what is, in my opinion, a tailwind here. So happy to talk more about that, but very, very positive. And it'd be nice to see a bit more building. Housing starts last year were around 5,000, not anywhere near our peak. But that was in line with what we saw the previous year and well above our 5-year average. Economy, I talked about it. We're gonna, and I'm happy to take more questions on reopen. My view on the virus, I think we really are in the tail end of this, and it's not clear. When does it feel? Everyone wants to know when is it going to be normal. I think it's going to start to feel pretty normal here in March and in April in some ways. Does that mean 10,000 people at a basketball game? No. But does that mean more confidence to go to restaurants and retail and movie theaters and the like? I think you're going to see that here very shortly in the next month or so. Our economy's been operating roughly at 80 to 85% capacity, and I think we should be able to get that to 90 to 95% here in the next month or so. Couple last things before I turn it over to John. Healthy communities, vaccine rollout. Happy to go into that in more detail. The state, on a per capita basis, has done quite well. Just under 18% of the state has been vaccinated. In addition, the roughly 75%, I believe, of those over 75 have been vaccinated or at least one shot, and I think close to 50% now of those 65 and older. That matters because 90% of our deaths, 90, are from that age range. So to the extent that we can insulate and protect that group, a lot less deaths, a lot less stress on our hospital system, and that's going to really encourage this more normal feel in my mind. And you will have some transmission, but with J&J vaccine coming online, we think it's months, not quarters. And happy to talk more about the pivot too that the governor mentioned in terms of age-based versus occupation-based vaccine distribution. We just think it's going to be very effective from a speed perspective and really help us continue to lead on a per capita vaccination, where we hope that everyone has a chance to get vaccine by May. I'll just hit, this is my last slide before I turn it over to John. So legislative action, just a few things I'd note here. One, and I may have mentioned this last year, we were pursuing both of these last year, but given the short session, it didn't happen. We're trying to change the way the state does small business lending. Specifically, the state is trying to really get out of the small business lending business. We've got Peoples here and Webster and others. I'm sure the state, it's not our role to compete with banks, in our opinion. Certainly not right now. After the Great Recession, maybe there was a need for it, but we want banks to do their job and we want government to do their job. On the other main initiative that we're focused on is what we call Grow CT Jobs, which are these simplified performance-based initiatives for job creation or incentives for job creation. Can take any questions on that, but really we're trying to limit the spending on incentives broadly where taxpayer money is being put at risk, and we're just trying to be smarter about that. So we've reduced spending in DECD bonding by between 65 and 75% based on the 3 prior years before Lamont came into office. Business One Stop, I'll just mention this quickly. For those that haven't seen it, I would check out business.ct.gov. We are trying to have set up a actual streamlined interface for small businesses where you don't have a separate login for labor versus revenue services, and where you don't need to print stuff out and fax it in to the government anymore. Now, we're not there yet, but there have been some real steps taken over the past 6 months on this, and you're going to see more in the future. Transfer Act, happy to go through that. That happened in a special session. Really helpful for properties, manufacturers, in my opinion, make it easier to invest in the state. So listen, I don't want to overstay my welcome with this group. I'll stay on for the balance here, and happy to take any questions. Really appreciate the chamber having me, and great to be in the Valley.
All right. Thank you, David. Thank you very, very much. And I appreciate your willingness to stay on. We're going to hold the questions to the very end.
Sure.
The magic comes in the exchange with you and John as well. But you ended your comments about legislative priorities. I just do want to recognize we do have 3 legislators on the call this morning. State Representative Cara Rochelle, representing the great city of Ansonia, and 2 newly elected state leaders, Mary Wielander, state representative, representing Woodbridge, Derby, and Orange, and newly elected state senator George Cabrera, who represents the Valley and up into Hamden and in a very large area. Thank you to all of you for joining us this morning. It now gives me great pleasure to turn the second half of the program over to Chamber Director Justin Vescovi. Justin is Vice President and Market Manager at People's United Bank. He's been associated with the bank for 15 years, led a number of retail branches in and around the Valley, and in 2019 was promoted to Market Manager. So he is the public face in many ways here in our Valley. Same year, he was awarded the coveted CEO Leadership Award. So congratulations to you, Justin. Justin's a graduate of Sacred Heart University. He has deep roots in the Valley. In addition to serving here on the Chamber Board, he also serves as a director at the Shelton Economic Development Corporation. Justin, welcome and thank you. So please share some remarks and introduce our next speaker.
Thank you very much, Bill.
Have a good day, all.
Everybody can hear me?
Yes.
All right, wonderful. Yeah, thank you very much, Bill, Nancy, and Laura for putting this on again this year, and to David, a wonderful segment this morning, looking forward to the Q&A after John's presentation. So let me start by just saying that, we continue to be proud to meet the needs of the Valley residents and businesses, through our branch network, as well as our partners in treasury management, business banking, and People's United Advisors. The past year has provided challenges to us all, but we continue to provide expertise and solutions, to our clients. And I'm proud to say, to David's point, we helped commercial clients by approving over 18,000 applications for the payroll protection program in the first round last spring, and we continue to help currently as we're talking today. So People's made headlines this week with an announcement of an M&T acquisition. We're excited about the opportunity. We're going to use the new partnership to build on our mission-driven cultures, maintaining strong ties with the local communities, and I'm confident our shared banking community banking philosophies are going to provide significant long-term value to our employees, our loyal customers, and the communities that we operate in. So we're pleased again to co-sponsor, with John Zinno and CLA. We've enjoyed a wonderful partnership the last few decades, really, with the Chamber, and I'm happy to continue working with Bill and the board and all the members, to build upon the great Valley for years to come. So with that, it's my pleasure to be able to introduce, John Traynor, one of our company's leaders, our Chief Investment Officer. You've all met John before. John, among other duties, directs the overall investment process for our company. He serves as the chief spokesman for our firm's investment outlook, appears regularly on CNBC and Fox Business Report. John's a Villanova grad, a Connecticut resident, and it's my pleasure to introduce him again this morning. So with that, John, I will give you the stage.
All right, fantastic, Justin, and I just want everybody to know that Justin is not only a great banker, but he's a great technologist. So I'm going to follow his lead here and share my screen. Hopefully, this will all work. You all. All right, I'm going to start, and if you take a look at our presentation, you'll see Mr. Biden. We think we've got a big debate going on right now down in Congress, as David mentioned, the $1.9 trillion spending package. Hopefully, that'll get passed. I know, there's some debate about the size, but I don't think there's any doubt that we need the package. We need that support. So hopefully we'll see that. If you take a look at the next slide, if you go through what we believe, especially in the second half of this year, the theme for the economy, number one, the COVID vaccine. We need the vaccine to be delivered, and we need it to be taken. We need to achieve that herd immunity as soon as possible. As you heard David say, Connecticut's actually doing a very good job. We're ahead. I've got a great slide I'll show you in a couple of seconds. Connecticut's doing a great job in getting the vaccine out. We're one of the leading states. I think we're in the top 5 states in the country. But, we need to get that out. We need to get people to feel comfortable, to go back out to restaurants, to go back out to movie theaters, to go to concerts. We've got this, the new arena in Bridgeport here. We want people to go to that. Second, it flows right into confidence. We need to see consumer confidence. We also need to see business confidence. All the people on this call, the way we'll measure that is in capital spending. We need to see everybody on this call to say, I'm positive about my business. I'm positive about the economy. I'm going to invest. I'm going to expand my plant and equipment. I'm going to invest back in my business. We're keeping a very close eye on capital spending for businesses. And then finally, the political environment. We've gotten tremendous support. Think about where we were last year. We got tremendous support from the Fed. We're still getting that support. We got tremendous support from the federal government. The stimulus package last year, we passed another $900 billion in December, and we're talking about $1.9 trillion. So we've gotten tremendous support on the fiscal and the monetary side. There is some discussion about taxes. What I can say there, and you never know what gets passed, is at least I believe Joe Biden has said, you know what, the first thing we need to do is get the economy back on track. Then we'll talk about taxes. So we believe taxes will be going up, but I think their priorities are right. Get the economy going first, and then let's talk about taxes. And as you heard, I think Governor Lamont has done a very good job here in Connecticut saying, let's keep taxes low and keep this economy moving. I've only got 2 charts. I know I showed you a lot of charts last year, but one of the charts that I showed you was the LEI, the Leading Economic Index. And I know I told you that this has been a great indicator for when we go into a recession. And if you look prior to this, normally we get to 12 to 18 months. Take a look at the latest period. We got no warning. What we do believe, though, take a look at that sharp V bottom down at the down there in the March-April time period. We do believe this is showing us that even though we didn't get the warning about a recession, we do believe we're getting an indication that the economy is recovering. The economy is doing very, very well. This is one of the charts that we've used to really keep us focused on the markets. This is another chart that I showed you last year, and it's a little counterintuitive. Remember we talked about how over the last 30 years, wage increases have bounced between that 2 and 4% zone. Well, if you look back to last March and April, you'll see a tremendous spike. And you would think, well, that's fantastic. We had great wage increases without inflation. Unfortunately, what this chart tells you is that the people that lost their jobs were the low-wage workers. So, what you're seeing is a reflection not of a good economic trend. You're actually seeing a very bad economic trend. We were positive most, through the second half of last year. That line continued to come down. What that means is we were rehiring a lot of those low-wage workers, the waiters and waitresses that work in the restaurants, the people that work at the Trumbull Marriott. It's mostly, as David was saying, restaurants and hotels. That's where a lot of the damage was done. Unfortunately, we saw a little bit of a spike back up in January and February. The latest data was actually down, a little bit. So we want to see that line come down. I know normally you'd love to see, wage increases up with low inflation. We want to see that down. A healthy economy would see that line go back down below 4% because that means we're rehiring those low-wage workers. This chart, consumer confidence, this is all of us. This is everybody on the phone. And unfortunately, take a look at this. We're still, from a consumer confidence standpoint, pretty close to a recession low. We haven't seen that nice V bottom that we normally get off the lows coming out of a recession. Consumers are nervous. So, we're almost in the position where we're more comfortable going out and buying a new car than we are going to McDonald's. So what we need to see, and this is probably one of the best indicators that we have, this particular chart, as to whether or not we're coming out of the recession. What this tells us is consumers' likelihood to go out, go to dinner on Main Street, go back out and rejoin the economy. When this line starts moving up consistently, and we believe it will as vaccinations increase, but once we see that increasing, then you'll get a pretty good sense that the economy is rebounding very, very nicely. This is business confidence. Again, this is everybody on the phone. You'll see that we did bounce off the bottom pretty nicely. Businesses did fairly well, especially if you're on the manufacturing side. It turned down in December and January as soon as the weather got cold and we restaurants started to close up, even with that limited amount of business they were doing. We believe we will see this increase. You'll see the last little tick there was up. We believe we'll see that increase. But again, this will tell us whether you all, everyone on this call, will start to invest back in your business. You need that confidence. This is a great chart, and it flows in with some of what David was just talking about. This comes from the Boston Fed. This compares New England with the United States. All right. So take a look at that very bottom, the two bars on the bottom there, leisure and hospitality. Those are the restaurants. Those are the hotels. Take a look at the devastation. This is just the change in employment from November 19 to November 20, down a little over 28%. Now, in Connecticut, when this chart was done, was probably closer to 17%. So even though, we've been hammered, and again, that this is an area that's been very, very tough, Connecticut did a little bit better than the national average. The worst state in New England is actually Vermont. Their leisure and hospitality jobs are down 35% over this time period. So, there's been tremendous devastation in New England, primarily because we've got a very good tourism industry. The other line I'd love you to take a look at, go up a few lines and take a look at manufacturing. Now, normally in a recession, those manufacturing bars are all the way across. Manufacturing gets devastated. Look at how well New England manufacturing held up. Look at how well United States manufacturing held up. This has really been a very, very different recession. Normally, the service industries act like shock absorbers. We may not buy a new car, but we'll still go out to a restaurant. The exact opposite happened in this recession. So it's very, very telling. And again, because of some of the policies of Governor Lamont, our manufacturing in Connecticut here actually held up very well. You'll take a look here on the manufacturing side. The manufacturing PMI is actually very, very strong. So we're encouraged by the strength in manufacturing. So this is a very, very good sign. I cut this chart, these two charts, out of The Economist. I thought it was great. They were side by side. Again, as a Chamber of Commerce, take a look at that chart on the right. Those are, and this is put together by the Department of Commerce, those are high propensity business applications. And they rate them by, this is not only an application, but it looks like it's going to really, develop into a good business. They're off the chart.
Hey, John.
Yes.
Sorry to interrupt you. Sorry to interrupt. It's David. I think your screen share stopped. At least it did for me.
Uh-oh.
Can others still see it?
Should I try and start over?
A little box with the arrow at the bottom, but if you need me to, I can as well. So if Nancy can set me up.
How's that? Justin, why don't you take over? I might have a bad connection here.
Yeah, you're back now.
I'm back? Okay, great. All right. Well, I'll rush through these last few slides, but again, what we're seeing is that hopefully, mom and dad are sitting at the kitchen table and they're saying, you know what, we've always thought about starting a business. Maybe this is our opportunity. So we're seeing that. So, this could be the seed corn for the recovery we see this year. Take a look at this. Again, this is another data point that David was talking about, and this chart is about a month old. But take a look at the vaccinations. Compared to the rest of the world, the United States is doing very, very well. The UK is now closer to 25%. If you take a look at this chart, you'll see that when this was done, the US was at 10. The US is higher. Connecticut, when this was done, was closer to 13, 14%. And as David said, we're even higher. So the United States, believe it or not, is actually doing a very good job at administering the vaccine. And Connecticut, again, is one of the leaders. These are unemployment rates, just across the rest of the New England states. We certainly suffered, and we think Connecticut is going to rebound. If you take a look at housing prices, you'll see that Connecticut, if you're taking a look at your home or your neighbor's home, Connecticut's doing well, New England's doing well. We think this will continue. From an economic standpoint, economic forecast standpoint, our 2021 projection at 4.7%, we believe that's going to go higher. The real fulcrum there is when do we get herd immunity? So we think we're going to see that. So maybe 3 months ago, I probably would have told you our forecast was closer to 4%. We've been slowly moving that up. I would say our next move is going to get that up to 5%. So essentially, I think a year ago, I showed you this chart, the sugar rush versus the virtuous cycle. We thought we were in a sugar rush, that the economy was slowing last year. It slowed a heck of a lot more than we thought. We believe if we get the herd immunity, if we get the support from the Fed and on monetary policy and out of Congress on the fiscal policy, we believe all of those things could get us to a virtuous cycle. So we think this year could be good, and it could flow into next year. If you take a look, I'm sure we're going to get a few questions on the political side. That red bar there, that's what happens when you have the Democrats control Congress and the Democrats control the White House. We normally get a pretty good market. The market tends to like divided government a little bit more, but still, we think we're going to have a good financial market going forward. This is a chart that concerns us. We talked about taxes a little earlier. One of the things that President Trump did was he lowered that red line, U.S. corporate taxes, to get closer to the international level. What you saw, those bars, those were all the companies leaving the U.S. So you've seen in the last few years, we did not have that. If we see the rate go back up, and Joe Biden has said he doesn't want to go back to the 35% rate, he probably wants to go to 28%. One of the things we're going to keep an eye on is, does that make us less competitive internationally? It's very, very important. This is a great chart. This was in the Wall Street Journal. And, I get a lot of questions by people saying, gee, everything blew up last year on the political side. We had, racial problems. And you know what? A lot of our problems, and this was really the highlight here, goes back to 1980, then 2000 and 2020. This just shows how politically divided we are, that from a landslide county, there are 3,000 counties in the U.S. From a national basis, we've been becoming more and more divided. So, a lot of the problems that bubbled up last year have really been with us for quite some time. Basically, when we build portfolios, we're saying right now you should be focused on not the late cycle, but building more early cycle. We've been increasing the amount of small cap exposure. We've been increasing the amount of value exposure in portfolios. So we think that's the proper way to position yourself. This is a chart that I love on risk. Basically tells you that very often when things are most euphoric, that usually is a pretty risky time in the market. And actually last March and April, when things looked terrible, well, that turned out to be a pretty good time. So just, controlling the emotions is key to success. This chart, even if the lines here are very, very smooth, this top line, those were the 5 big tech stocks. The middle line is the S&P 500, all 500 stocks. And that bottom blue line, those are the other 495 stocks. So you see last year that, the investing, if you didn't own the top 5 tech stocks, you did not do well. What we believe is going to happen this year is those two lines are going to reverse, that the 495 are going to outperform the five big tech stocks. And we're starting to see that. That's, what you saw yesterday in the market. The tech stocks did much worse than the rest of the market. So we think that's actually a healthy trend, a broadening of the market. This, I won't go into too much detail here. This is the growth versus value. Value is the white section. The green section is growth. Normally, trees don't grow to the sky, so we've been moving more toward value in our portfolios. Growth has been the place to be since 2006, but increasing the value component in your portfolio probably makes sense. And then, as a summary, we think we're going to grow this year. We think we'll probably slow down in 2022, probably closer to the 2.5% to 3%. We're very, very focused on capital spending. We want to see businesses increase their spending. Connecticut is very, very well situated. A lot of our manufacturing is advanced manufacturing, which should do very, very well. And then when it comes to the markets, we're seeing what we would call a beta rally or a risk-on rally. So we think that will continue. So I will stop there, Bill, and I will send it back to you.
Thank you so much, John. That was outstanding. And we are going to move into Q&A for the next 15 or 20 minutes. Nancy Gray, who's the wizard behind the curtain, will bring you to the stage. I know Dave Morgan has a question. So please gather your questions. I'm going to start. Gentlemen, I have Wednesday's business page in front of me, and the headline story is Connecticut gets boost as more see states' advantages during the pandemic. And this speaks, David, to your point about the influx of residents, some 16,000 plus. Below that is another story. It says Eversource offers sessions on payment programs. About 3 out of every 4 of Eversource's 1.1 million residential customers are behind on their bill payments. They're probably also behind on their rent or their mortgage payments. So how are we preparing, certainly from a state policy perspective, as well as from the banking community, the pressure on property owners, right? Small property owners, as well as larger real estate developers. So to both of you, John, why don't you start on that question?
Well, again, I'd say from the city standpoint, your first point, we believe we're going to see people continue to move out to Connecticut. We think it's going to be, we're benefiting from that in Fairfield County, certainly. We need the cities. I'm sure I'm not going to have all 25 in the office every day. So that's fantastic. They'll be working from home and working remotely. That's and in the office. Your more important point, though, about Connecticut, and that's really why I think David and I stressed the amount of fiscal support. There is a tremendous amount of pain. Let me give you one stat. If you divided the economy by jobs above 60,000 and below 60,000, compared to where we were the last time we all got together there in March, for people above 60,000, there are actually 5% more jobs for those people. They're actually in better shape than they were a year ago. For people in the bottom quintile, the bottom 20%, there are still 20% fewer jobs. So, a lot of us on this call, maybe, our business is pretty good and our families are healthy. But boy, there is a lot of pain, and it's a real dichotomy out there. And I think the federal government, and I know a lot of the policies that David and Governor Lamont have talked about, are taking care of that other group. But David, I'll toss it to you.
Yeah, I would just say a few things here, and it's the right question, Bill, and it's a complex one, I think. But first things first, I think this, getting back to normal underscores the need to embrace the vaccine rollout, to try to get the state vaccinated quickly, because every week matters there in terms of the economy coming back and how circular that tends to be. So there's a lot of focus on that, obviously, because that's crucial for returning life to normal and getting a lot of these jobs back, in our opinion. In addition, the federal stimulus, as has been mentioned a lot of different times, the stimulus, the direct checks, the payment protection program, all of this is trying to just get money in in people's hands so they can pay their rent, they can pay their utilities. We realize even with that, there's a lot of stress. The governor has announced several rounds of rental assistance going to tenants and directly to landlords effectively. There have been moratoriums on utilities being shut off. The eviction moratorium obviously is still out there. So there have been various protections that have been put in place, but all of that it's a stopgap until we get this economy going again, where those jobs can be regained and people can get back on their feet as it relates to payment of rent and utilities. I guess the last thing I would say, and this is one of the reasons why I think the PPP program has been so effective, the rental assistance that we've done at the state level has been focused on residential and landlords. In PPP, commercial rent and utilities is an eligible expense under PPP that can be forgiven. So having commercial tenants get PPP so they can pay their landlords, that's one of the best ways to get grant money into the state, and we've really been encouraging that.
Great. All right. I think we have David Morgan is with us, and Nancy, I don't know if you can work your magic and bring David to the floor, to the stage. Dave Morgan is the president of Team Inc., which is our anti-poverty agency. So excellent segue. Dave, are you there? He's coming. And following Dave, I want to put Chris DiPentima on notice. Chris is with us as well. Chris, we're going to bring you on after David's question. David, you have the floor.
Hi, good morning, everyone. Thank you for the great presentations. Mr. Lehman, thanks again for all you're doing. My question is, could you briefly speak to the Emergent Earn As You Grow program, and what does it mean for distressed communities, businesses within distressed communities, and equally important, what does it mean for distressed citizens looking for job opportunity?
Yeah, that's a good question. So the program is really a whole-scale change in our incentives to be transparent, where all communities throughout the state know, whether it's an employer in the state or an employer coming to the state, if you create a certain amount of jobs in certain industries above a certain wage, then you're eligible for this benefit. And the way that it's structured, we want to keep it very simple. There's no black box. It's not the commissioner of DECD or his or her designee taking a decision. It's a 25 or 50% rebate back to the company, back to the employer. And it's 50% in our distressed municipalities and in our opportunity zones. And the reason is we want to incentivize job creation, good paying job creation in those areas. So we're just trying to keep it simple. It's 2x the benefit. If it was $1,000 per year per job, outside of an opportunity zone, it's $2,000 in an opportunity zone or a distressed municipality. I think our view is that will provide that new job creation or encouraging it in those areas. That should provide greater opportunities to residents in those areas, raise the median incomes in those areas, which is just much lower than the state. You have higher poverty in those areas, obviously, as well as higher unemployment. So we're trying, to the extent that the government can, and again, the market's going to do what it does, we're trying to encourage financially job creation in those areas, because we think that's going to increase the overall wages and opportunities for those that live there and work there.
Thank you very much. I do urge you to either raise your hand or put your questions in the chat box, but I do want to call Chris DiPentima. Chris was appointed as president of CBIA in 2020. He's become a good friend in the short amount of time. He brings to CBIA a 20-plus year career in manufacturing, headed up as president of Leggett & Platt Aerospace, a unit of an S&P 500 company, a lawyer by trade as well. So, Chris, thank you for joining us, and congratulations to you. Do you want to just maybe offer a couple of comments and maybe share a little bit about what's coming up legislatively with respect to Connecticut Business Day?
Yeah, Bill, thanks for having me. David, John, great presentation. I feel like I've been on the video with David every day for the past couple of weeks. He's getting sick of seeing my office here, but great job. And Bill, just before I talk about Business Day, the Earn As You Grow program, listen, CBI is a very vocal supporter of that program. The one thing we heard from the business community is let's get away from this picking of winners and losers and throwing lots of money at out-of-state organizations, and come up with a very, as David said, transparent, disciplined program that not only recruits folks from out of state, but really appreciates the folks that we have in the state who are growing their businesses. And so I think it's a great program. And as you said, Bill, at the opening, and John said, there's a lot of great things going on in Connecticut. And I think we're starting to see this shift into this rebuild and recovery, and the data center bill yesterday and some other some other great ideas that are out there about growing our economy. So Business Day, March 16th. For those of you who don't know, when coming on board to CBIA in August, one of my main strategic pillars was really tapping into the partnerships of the chambers. And CBIA, while we're up here doing the advocacy to grow our state and to really develop and nurture economic policies for our business community, the chambers are our grassroots. The chambers are the outreach. So when it comes to supporting things like the Earn It to Grow bill, they're the ones who charge the business community to go call your legislators. And so we're going to have a great panel, Bill, on March 16th around grassroots and what the business community can do. We're going to have DoorDash as one of the panelist speakers, a new CBIA member, and someone who's doing a lot of great things to for the business community to keep especially the restaurant community going, AT&T and some other businesses to talk about grassroots outreach. What does that mean? And so, Bill, I'm really looking forward to partnering with you and the rest of the chambers across the state on Business Day. Ironically enough, a year ago, Business Day was the first time Josh Caval came up to me and gave me the elbow, and I couldn't figure out what was going on. And that was the first case of COVID in Danbury, Connecticut that day. And it, as you said in the opening, it's been a radical change since then. So thanks for letting me jump on for a quick moment, and thanks for being such a great partner.
Yes, and thank you. Chris was down to tour some of our manufacturing companies just over the last couple of weeks, and you're always welcome, Chris, as are you, David. I want to thank David. David's been everywhere at once, it seems, and at the invitation of Representative Cara Rochelle and the delegation, spent a full morning here a couple of weeks ago looking at some of the redevelopment sites in downtown Ansonia and downtown Derby, and you've been a great partner, David. We appreciate it. We're going to try to call John Zeno back. Nancy, can we get John back up, our sponsor, for a question? Oh, you're muted, John.
There we go. Thank you, Bill. And David, John, great presentation. Insightful. So, we work with several real estate owners, agencies and brokers, and they are seeing historic sales. There's actually shortage of units right now. Are we starting to see a positive impact with additional income tax, sales tax, and other revenues at this point?
So the short answer, John, is yes. And if you look at conveyance taxes on real estate, for example, sales tax, that has outperformed. It's tough though, from a timing perspective, to truly attribute it to new residents and migration versus just the real estate boom that Connecticut's seen and that other states are seeing as well. I think we'll have a really good picture though, certainly a year from now, but hopefully mid-year, on new residents and when they file their tax returns in Connecticut for all or part of 2020, we'll have a sense then, okay, are these high earners, lower earners, capital gains is coming from them. But, at a macro level, the tax numbers continue to outperform across the board, income, sales, and otherwise. The only one that's disappointed has been the hotel occupancy tax has been terrible, as you'd expect, but everything else is wrong.
Good. Thank you.
John, one additional point. One of the stocks we own is Home Depot. And Home Depot will tell you that when somebody buys a new home, the amount of money that they spend in that first year, and think about all the new people that have bought homes, they're all going down. So, Connecticut is a big beneficiary. Not only are we seeing that, but all those new people, they're all going to Home Depot. They're all doing things on their homes. So there's just a tremendous amount of spin-off activity that's coming out of that, which has been great.
Oh yeah, try to get an electrician or a plumber to your house right now. It's virtually impossible.
Exactly.
Let me switch gears. I'm checking the chat box. Let's talk a little bit about infrastructure. Certainly it's one thing that we all can agree on is we need to invest in our infrastructure. Certainly here in the state of Connecticut, our delegation has been very bullish about the potential of reinvigorating the Waterbury branch line. For years, we've been talking about Route 34 improvements through the heart of downtown. I know Rick Dunn is on the call this morning, who's been championing that product from our COG. So to both of you, maybe from a national perspective as well as state, what can we expect? John and then David.
I'll go first. Yeah, well, this is a very interesting debate. In fact, you'll probably see some of this today down in Congress. There's an economist, Larry Summers, who's been very, very vocal saying, we're spending $1.9 trillion. We should instead of, sort of how the bill is structured now, let's spend that $1 trillion on infrastructure. I fully understand what he's saying, and he's made a good point. If we've got low rates, if we've got this opportunity right now, let's do it. Now, certainly, as David and I both say, we have a lot of people that are in pain. So we need we need to keep the income support. We need to support them. But there's an opportunity now to really invest in infrastructure on a national basis. And, certainly here in Connecticut, but on a national basis. I know Governor Lamont has talked about, just rebuilding the roads. Look at the regional program that the states are putting together on fuel taxes. So it's fantastic that Governor Lamont and what we're seeing up in Hartford is they get it. But the bigger issue, I think, is it's got to be down in Washington. I know Larry Summers has been one of the guys beating the drum saying, the next stimulus package has got to be 100% infrastructure. David, I'll hand it to you.
Yeah, no, I mean, you said it, but I think the two things I really just want to underscore are, one, big infrastructure, and this has been talked about in DC for years, if not over a decade, and it just hasn't happened. Maybe now truly is the time where there is consensus to try to rally around, really a framework for the economy to grow over the next, several generations in terms of infrastructure. And that's not just roads, that's, broadband. I hear about high-speed rail. There's lots of ideas out there. But you need the federal government to step up in a meaningful way to pay for it and put the debt on the federal, checkbook, if you will, as opposed to the state level. And I think that's the question. So we'll take the federal government's lead. Absent that, there are projects in Connecticut, but the truly transformational stuff is going to depend on if there is a bipartisan deal, in my opinion, and Biden really wants to get behind this.
Great. All right, gentlemen, I know, David, you have another very important engagement today. Let me say to our audience, with the consent of John and David, we have recorded this morning's presentation. And I'm going to ask both of you to be willing to share your slides as well. I know, John, you've already done so. And we will share this with our entire membership, and you're welcome to share it, internally with your team. This is great data here this morning, really wonderful. Chris, we will be promoting. We'll send a letter next week to our membership, inviting them to participate on March 16th. The governor will kick it off, and this will be a statewide event with all the chambers across the state, with the leadership of my friend Lynn Ward, who is currently the chair of our statewide association, and Chris. So please come on for all or a portion of that. It's going to run from 8 to 11 o'clock, I believe. And then we're also in the planning stages as a follow-up to that to bring the Valley legislative delegation. I mentioned 3 of them on the call this morning, likely in early April, to talk about your priorities and their priorities for our All-America City Valley. So with that, I'm going to let you go. I want you to enjoy this magnificent early spring day here in Connecticut, the brilliant sun, the brilliant skies here today. Thank you again. We'll give a virtual round of applause to our sponsors. Thank you, John Zinno. Thank you, Justin. And to our outstanding panel, John Traynor and David Lehman. Thank you. Have a wonderful day, wonderful weekend.
Thanks for having us.
Thank you, Bill.
Bye-bye now. And you